What is going on, guys? Nick here, back with another video. 2022 is finally here, and I spent the last week looking through the finances of a lot of different companies looking for undervalued stocks. And after all that searching, I found 7 high upside stocks that you can buy and hold in 2022. Stock number 1. So the first company should be no surprise if you've been following my channel. It's Visa. Visa had a brutal second half of 2021, dropping from $250 per share all the way down to $190 towards the end of November. The drop came after a couple earnings reports came in a little shy of expectations. They faced some financial pressure over the past 2 years with slower revenue and profit growth than they've seen in the past. However, after looking further into the cause, the drop-off is due to a lack of international transaction revenue, which is earned when someone visits a foreign country and pays using their Visa card. Visa charges a foreign transaction fee, and because there's less international travel because of COVID, they're just missing this segment right now. As travel does start to return, this will come back very quickly. On top of this, the rest of Visa segments have seen very solid growth consistent with the past, so Visa's core business is doing very well. If we look at Visa's revenue and net income, we can see just how insane of a money-making machine this company is. Over the past year, while earning $24 billion in revenue, the company has earned $12 billion in profits. This is one of the most insane profit margins that I've seen of any mega cap stock out there. When we look at their forecasted earnings, we can see that while things have been down a little bit lately, growth is expected to return in 2022 and going forward. When we look at the revenue growth, we can see over the next couple of years it's projected to be somewhere between 12 and 17%, which using my PE calculator, a 12% growth rate comes out to a fair PE value of 27, and a 17% growth rate comes out to a fair PE value of 42. When we chart these multiples out compared with their forecasted earnings per share, we can see by 2023 Visa has an upside of $265 per share to $412, which is a low-end upside of 22% and a high-end upside of 90%. Stock number 2. Sticking with fintech, corner the payments market by adding to your Visa stock, its buddy MasterCard. Now, the same thing that hurt Visa, its lack of cross-border transaction volume, is the same thing that's hurting MasterCard. And just like Visa, as international travel does open back up, we'll see both of these companies return to the insane growth of the past. Now, there are plenty of people out there talking about all the big macroeconomic risks, things like inflation, the labor shortage, the supply chain crisis, but both Visa and MasterCard are pretty protected from these issues. They make their money by charging fees to merchants when people use their cards, not by loaning money or selling products. The only thing you have to worry about as a Visa or MasterCard shareholder is making sure that people continue to make transactions using their MasterCards. Now, when we look at MasterCard's revenue and net income, we can see a business just as impressive as Visa. We see the same very high profit margins, we see the dip in 2022 due to the lack of cross-border transactions, but we also see over the last year MasterCard has made a lot of that decline back. When we look at MasterCard's forward earnings, we can see that they're projected to do very well going forward and maintain their historical growth. Looking at the revenue growth, we can see they're actually projected just slightly higher numbers than Visa, with 23% growth by the end of 2021 and still a very strong 19 and 16% growth by 2023. I think a fair growth rate for MasterCard is between 15% for the low end and 20% for the top end. This gives MasterCard a fair value between 35 for the low end and 55 for the high end. Compared with MasterCard's forward earnings, this puts MasterCard's upside by 2023 as low as $453 per share, or 25% upside from today's $360 per share, and as high as $712 per share, or 97% upside from today's share price. Stock number 3. It's Qualcomm. Now, Qualcomm has been beaten up through most of 2021, but before I get to that, let me talk about what Qualcomm does for anybody who doesn't know already. Qualcomm has been the leader of the smartphone chip market for a long time. On top of chip sales, they also license out their designs for other companies to use. Now, like I said, Qualcomm has been beaten up through 2021, and the stock fell quite a bit in the first half of the year. Qualcomm has slowly been losing market share to MediaTek in the smartphone chip business and is now number 2 to MediaTek after they took a lot of the market share from Qualcomm in the low-end to mid-range smartphone chip business. On top of this, Qualcomm has lost one of their major customers, Apple, over the past few years as Apple has started to build its own iPhone and iPad chips in-house. Currently, Qualcomm supplies the modems used in iPhones, but Apple acquired a modem business for $1 billion from Intel, so it's likely Qualcomm will lose the iPhone modems eventually too. And by 2023, they expect to supply only about 20% of the modem chips used in iPhones. However, Qualcomm hasn't just sat around and watched their market dominance erode. They've been working to diversify their business beyond the smartphone chip business. In 2021 alone, they first bought Nuvia for $1.4 billion to boost their data center chip business. and Veoneer for $4.5 billion. Veoneer is one of the largest software and sensor makers used by automakers to build autonomous driving systems, so this helps give them access to the automotive chip market. Recently, Qualcomm announced that even with all of the negative news around their chip business, they still expect to grow it by 12% per year going forward. Qualcomm has expanded into growing the smart appliance chip business, and over the past year, they brought in $5 billion from the segment. By 2024, Qualcomm expects this to grow to $9 billion. When we look at the revenue and net income, we can see how the company was very up and down, with revenues declining from 2014 to 2018. However, the past year, the company has really seen things turn around, hitting record revenues. The current Wall Street estimates see the business continuing this growth, hitting $54 billion in revenue and almost $14 billion in profits by 2024. When we look at Qualcomm's growth, we can see they currently are expected to continue growing by at least 7%, and I think a fair estimate for the company is to continue growing around 7% for the bottom end and 10% for the top end. This gives us a low-end fair PE value of 17 and a top-end fair PE value of 22. When we chart this out by 2024, that gives Qualcomm a low-end upside estimate of 212 per share or 14% upside, and a high-end range of 275 or 48% upside in just 3 years. Stock number 4. It's Chipotle. And now Chipotle has had a pretty wild decade. Back in 2015, the stock was plummeting after E. coli outbreaks continued to hit the store. Customers like myself, who treat Chipotle like a cult, were avoiding the restaurant. Eventually, Chipotle's founder, Steve Ells, who had run the company since 1993, was forced out, and Brian Niccol came over from Taco Bell and took over the business. Since recovering from the E. coli outbreaks, the stock has been on fire, rising from $300 in 2018 to its current price of $1,770 per share. Now, when COVID hit, there were a lot of businesses, especially restaurants, that really struggled to adapt. For some fast food stores, the response was pretty obvious: put all the focus on the drive-thru. But Chipotle really doesn't have drive-thrus, so this really wasn't an option. Instead, they started pushing customers to digital orders, where customers could place orders online and then choose delivery or pickup. And Chipotle has pulled this off really well. At this point, half of Chipotle's sales come from digital sales, and on top of this, Chipotle has continued to open new restaurants with 124 new stores in 2021. When we look at Chipotle's revenue and net income, we can see a giant scar from the E. coli outbreak. Not only did it take 3 years for them to be able to match their prior revenue, but profits still hadn't passed their 2015 numbers until just this year. But when we look at their forecasted earnings, we can see the business is projected very impressive growth, hitting just shy of $10 billion in revenue and $1 billion in profits by 2023. When we look at their revenue growth, we can see 2021 saw all the way up to 26% growth, but revenue is projected to slow down to just 13% by 2023. However, when we move over to net income growth, we can see that Chipotle is forecasted to completely blow away these revenue numbers with 30% and 27% growth going forward. I think the bottom end growth rate to value Chipotle should be just a little shy of these net income numbers. So for the bottom end growth rate, I think 20% seems reasonable, and for the top end growth rate, I'll go with 25%. A 20% growth rate comes out to a fair PE value of 55, and a 25% growth rate comes out to a fair PE value of 82. When we look at Chipotle's valuation forecasted out to 2023, we can see they have an upside of at least $2,300 or 30%, and a top-end valuation estimate of $3,441 or 94% upside. Stock number 5. VMware. Now, VMware is a little bit of a different buy than the rest of these companies. The stock has sold off way too far, and even with its relatively slow growth, it should come back up to a much higher price than the current share price. In 2015, Dell acquired VMware as part of a massive $58 billion deal after Dell acquired EMC. In April of 2021, Dell announced it was going to spin off VMware. The agreement called for VMware to pay a special cash dividend of around $28 per share, with about $9.5 billion going back to Dell. Now, what exactly is VMware? Well, they're one of the pioneers of virtual computers, where users are able to log into a computer and access virtual computers running on a server from anywhere. This means that you could have an office in one city and have a separate computer at your house and operate on the same exact desktop from your computer or at home without having to carry around a computer. Now, when we look at the revenue versus net income, we can see the company has shown very steady and consistent growth, but profits are a little more up and down. However, they are still pretty consistently going up and in the right direction. When we add in their forecasted growth, Wall Street expects pretty solid revenue and net income growth over the next 3 years. VMware is expected to grow from $12 billion in revenue and $2 billion in profits over the past year to $15 billion in revenue and $3.4 billion in profits by 2024. When we look at the revenue growth, we can see we should expect them to maintain a steady high single-digit growth percentage going forward. And when we move over to their net income growth, we can see a slightly higher percentage except for 2023. So I think a low-end growth rate of 7% seems pretty reasonable for VMware, and a high-end growth rate of 12% also makes a lot of sense. This gives us a fair PE value between 17 and 27% for the company. Now, when we look at this valuation charted out, we can see there currently isn't a lot of upside by the end of 2022 or 2023, but we do see by 2024 VMware having 19% upside for the low-end range, and for the top-end range, 90% upside. Stock number 6. Okay, so this is a stock that I actually recommended in my first and only ever Stocks to Buy Now video. And if you had bought back then, about a year and a half ago, you'd be up 53% since then. But if you didn't, there's no need to worry because the stock still has a lot of upside. And that stock is CVS. CVS is a powerhouse in the pharmacy market. Approximately 1 out of every 4 Americans get their prescriptions filled through CVS. And at the end of 2017, CVS purchased Aetna, a health insurance company, with the goal of creating a more vertically integrated healthcare company. Basically, CVS wants to take advantage of owning both the health insurance company and the pharmacy company filling these prescriptions by reducing the cost to fill the prescriptions in the first place. On top of this, CVS operates about 1,100 minute clinics where customers can quickly and conveniently walk in to see a doctor for common illnesses. CVS's stock price rise is mostly due to a solid increase in its earnings. When we break down its business by its segments, we can see where they're increasing. It's a little hard to see just because their margins are so small, so let's fix that by zooming in just to see up to $10 billion. So here we can see that each segment is a little different. The pharmacy business is their most consistent grower of each segment, and their healthcare business has actually fallen slightly from 2020. Their retail division, which I actually think a lot of people consider as just an afterthought, is actually their biggest profit generator, but only by a slight amount. If we look at CVS's past decade of revenue and earnings, we can see revenue has shown very steady and consistent profit and revenue growth. However, CVS does have very small profit margins. While they brought in $285 billion in revenue over the past year, they only took in $7.5 billion in profits. When we add in their forecasted earnings, we can see that both revenue and profits are expected to increase. By 2023, the expectations are for CVS to grow to $318 billion in revenue and $11.7 billion in profits. When we look at their revenue growth, we can see it's not the craziest growth stock out there, with the next few years only expected to grow between 8 and 4%. If we use these growth rates to value CVS, a growth rate of 4% comes out to a fair PE value of 13, and our top end growth rate of 8% comes out to a fair PE value of 19. Looking at these values charted out, CVS currently has a 2023 upside of at least 116 per share or 12% upside to 170 per share or 63% upside. I think at the current price, CVS is trading right around its fair value at 103 per share. Stock number 7. Okay, last but definitely not least on this video is a company that I made a video on just a couple weeks ago. It's Ford. Ford over the past 10 to 15 years has really underperformed. And by that, I mean the stock price has not just underperformed, but it's actually been falling. In 2022, Ford got a new CEO, Jim Farley, who to me seems like a guy who just really loves cars and has put a lot of that focus back into the company. Ford has really moved their focus to EVs with an all-electric Mustang as well as an all-electric F-150, which they actually had to stop taking pre-orders on because they wanted to make sure that they can meet the demand with the chip shortage. Speaking of the chip shortage, if you haven't heard, most companies are having a lot of trouble getting in chips that they need to build their products. And this has really hit new car production. It's driven the cost of new cars up, along with used cars, so there's not a lot of alternatives if you need a different car. Ford has responded to this chip shortage by prioritizing its more high-profit cars. Aside from just selling more profitable cars, they've also been selling more electric vehicles, which have higher profit margins as well. Looking at Ford's revenue versus net income, we can see 2020 has taken a huge chunk of revenue from the business. And while in 2019 Ford did break even, in 2020 they took a slight loss. During the past year, even with much less revenue though, they've shown a profit profit, bringing in $134 billion in revenue and just under $3 billion in profits. When we look at their forecasted revenue and earnings, we can see they are projected to show pretty considerable revenue growth, and they're projected to continue to grow their profits all the way to almost $10 billion in profits by 2023. When we look at the revenue growth, we can see that Ford is growing much faster than they recently have, with 14 and 13% growth forecasted over the next few years. However, I do think because Ford is an older car company, I don't think that it's that likely that they maintain that high of a growth rate. I think to value Ford, we should use the historic growth rate that I've used to value them at 3% growth, and for the top end of the range, I think 8% growth is pretty fair. This translates to a low-end fair PE value of 12 and a top-end fair PE value of 19. Looking at this valuation charted out, we can see that at today's share price of $20, Ford has a lot of upside. By 2023, Ford has a projected upside of at least $28 per share, or 37% upside, and for the top end of the range, an upside of $45 per share, or 117% upside. Okay guys, just to recap all the companies that I covered in this video and their current prices so that if you're watching in the future, you can see the deals you missed out on. Now, before you go, I definitely recommend you guys check out this video I have here for you next, and as always, thanks for watching.